Welcome to the weekly update, where I'll go over the action in the market from Monday, January 23rd through Friday, January 27th, and then we'll see how things look for the week of January 30th through February 3rd. We had another pretty solid up week. There's a lot of folks who are just completely convinced that the market was going to go down, but it's been going up. Our technical picture is starting to improve. Looking back at this week's session, the S&P had a good week and it's further above its 200-day moving average. That's kind of the line in the sand. When we're above the 200-day moving average, that's considered positive. When we're below, that's considered negative. On Monday, there was a Wall Street Journal article that people had a chance to react to. It was posted over the weekend by Nick Timiros, and I don't know if I'm saying that right. From what I heard, he is the reporter for the Wall Street Journal that has kind of an inside track with the Fed. When they want to float something out on the market, they know that a lot of people read the Wall Street Journal, so they kind of clue him in. He then writes an article. The market has a chance to react to that. We have to be careful with that because last year he floated one of these ideas out there. The market picked up on it and interpreted that as a Fed pivot. The market started going up and up and up, only to be dashed, and then we came crashing back down. The market did have a chance to react to this, and so far the reaction has been positive without necessarily anything from the Fed to distinguish that. But basically the idea is suggesting what the market's been suggesting all along whenever we have a fairly good day, that the Fed may be able to pause its rate hikes at some point in the future, but he's suggesting that possibly in the spring. And this provided a real positive backdrop for stocks, at least on Monday. Then on Tuesday, there was a little bit of a problem at the NYSE where they had exchange-related issues. Fortunately, it was resolved pretty quickly. And what happened is any trades that took place during that time, some were declared to be erroneous, while others were actually busted, as if they never happened. What I heard was that somebody in another area forgot to turn off a backup computer, and that totally messed up the whole system, at least for a short period of time. Also on Tuesday, there was disappointing earnings or guidance from 3M, Verizon, Union Pacific, General Electric, in addition to news that the U.S. filed an antitrust lawsuit against Google because of their dominance in the digital advertising arena. Defense-related companies such as Lockheed Martin, Raytheon reported pleasing quarterly results, which helped offset some of the weakness on Tuesday. Germany and the U.S. reached an agreement where they're going to start supplying tanks to Ukraine. That is more of a geopolitical thing, but it could feed into the stock market if this thing starts to escalate. It's already a really bad situation in Ukraine, but this could take it to another level. That's what the fear is. Then on Wednesday, Microsoft came out with some disappointing news. They had a pretty dismal third quarter outlook, and they expected the growth that they've been experiencing with their Azure business to slow down. Investors did have a chance to have a negative reaction to earnings results or guidance from Boeing, Texas Instruments, Kimberly-Clark, and Norfolk Southern. But Capital One came in with a good report. The S&P during the week did slip below its 200-day moving average. But we had a really strong reversal. And if you look at the chart that I'll show you here in just a moment, we bounced up off the 39.50 level and have had a really solid uptrend ever since then, except for some weakness going into the close on Friday. Tesla had a pretty strong quarterly result, and they also projected a positive outlook. Chevron also announced a massive $75 billion stock repurchase program. Then on Thursday, the market liked the advanced GDP report, the weekly jobless claims, even though they've been weaker than expected, meaning that there's fewer people filing for unemployment, and durable goods orders. Those all came in better than expected. This was one of those rare days lately where good news is being taken as good news. If we get too much good news, the market freaks out because that can appear to be inflationary and it starts to go down. On Thursday, buying continued all the way into the close. There was probably a lot of short covering that goes on. Those people sell to get in, they have to buy to get out, and that can really push prices up higher. And then you have a thing called FOMO, the fear of missing out. That people are like, wait a minute, I thought the market was going to go down. I sold my stocks in December. The market's not supposed to be doing this. Oh my goodness, I better do something about that. And then they jump into the market. That is likely what is happening. We don't have really any proof for that. But if you look at the psychology of the market lately, where it was so negative and now the market's going up, it's catching a lot of people off guard. Then on Friday, Intel had a really bad report. KLA Corp, they also had below consensus guidance. And then Chevron, which had that really good run up on Thursday when they announced the share buyback, well, then they reported their earnings on Friday and it wasn't all that great. And then Hasbro, apparently the people didn't buy enough toys, so they're issuing a fourth quarter profit warning. And then we also had a lot of economic data, personal income and spending, that came out, and the market seemed to like that. Even though it could have picked up on some of that and just tanked, it decided not to. The market ended up going up anyway. There was some weakness going into the close. We're not really sure what to think of that other than it was likely profit taking. For the week, the S&P 500 was up 2.47%. Volume was above average, so we're seeing some healthy volume lately. And the technicals were shifting back more positive. And there's some real critical areas that we're at right now, and I'll go through those within this video, and then I'll be hitting another area towards the end of the video. And a lot of what's driving the market right now is inflation and interest rates. We need to keep an eye on all the geopolitical concerns out there, specifically Russia, Ukraine. Earnings season, we're right in the middle of that, and that can always have an impact on the market. The recession debate, it's still going on, whether we're going to be in a recession or we're not. Is it going to be a really bad recession? Is it going to be a not very bad recession? Are we already in one now? Blah, blah, blah. And then we won't get any Fed speak outside of the FOMC, and they will be meeting this coming week, and they'll have their big announcement. There'll also be a press conference after that meeting. Our trend is weakening, but it's turning positive. We're starting to see the green line on top now. So that's looking better. We're looking better on the daily charts. And now we're starting to see some improvement on the weekly charts. Here's our intraday look at the market. Going all the way back to Monday, we had a really nice solid open. And then we went sideways for a while and then finished well off of the highs in Monday's session. Tuesday was pretty much a yawner. We were lower at the open and then just skipped along sideways. Wednesday, we gapped down lower, and this was when a big thing happened. We came all the way down to this 39.50 level. That was the low, and you can see what we did after that. Pretty much all the way until Friday. We hit R2 on Friday and then saw some profit taking or weakness going into the close, but this was a really solid run-up. For the week, the Dow was up 1.8%. The NASDAQ, which has been doing quite well in 2023 so far, it was up 4.3% on the week, and it just got killed back in 2022. The S&P was up about 2.5% if you round it up, and the small caps were up 2.4%. Here's a look at how the indexes did for the past week, where the NASDAQ and the NASDAQ 100 did the best. These are just the last 5 trading days. This chart does not go from Friday to Friday, just to give us a little different look. The S&P did pretty well during the week, and all the other indexes were up on the week. This is looking back to the beginning of the year. You have the NASDAQ and the NASDAQ 100 that are leading the way higher, and the S&P is doing okay. But again, the big thing to take from this is that all the indexes are positive. This is going back to the all-time high. All of the indexes continue to be negative since that point, with the NASDAQ 100 and the NASDAQ leading things lower. Looking at some of our sectors, this is interesting. This is a week old, but this just shows the returns for the week of the 13th of January through the 20th of January, and how communication services, which was mightily out of favor in 2022, it just had a really good week, followed by energy and then IT right in here. Two of these 3 areas. Energy's done well, but IT and communication really suffered in 2022, where a lot of these other ones are still supporting downward returns. This is going back the last 5 trading days to look at all the sectors. Discretionary, which really suffered in 2022, it did the best. It was up 6.41%. Communication, tech, these top 3 areas really suffered, and now they're doing the best. And we're wondering, is there a real shift going on in the market? The areas that were the weakest were utilities and healthcare. Utilities was the sector to be in 2022. It was actually down on the week. Here's a look at how the sectors performed just in the last 5 trading days. Discretionary, real estate, communication, tech doing quite well. And then utilities and healthcare were actually decliners. This is going back to the all-time high, showing how energy has performed the best and all the other sectors were negative since the all-time high. Looking at current market valuation, right now it's giving us a reading at fair valued when you take it all together. Here's the aggregate score. If we get above this yellow line, that's when we start to get overbought, according to this particular model. We're looking healthy. We're above the dash line. We're a little bit above that. It's positive. If we drop below that, that's negative. So we're not considered overvalued at this point, according to this model. There's other models we can look at that does suggest that we're still overvalued. The yield curve model, because it's inverted right now, suggests that we really are overvalued. So that's one part of this model that is overvalued. The Buffett indicator, when you compare stocks to GDP, it's right below this yellow line. If we go above that, then stocks would be considered to be overvalued. When they get really overvalued is when we go above that red line. Looking at the price earnings model, this is suggesting that we are overvalued, and we have some other indications of that. If we decline in price, or if earnings go up, which that's not happening right now, earnings are going down, the only way that we could get this back to a fairly valued mark right now anyway would be if the price of the S&P dropped. And then interest rate model is considered fairly valued. We're just a little bit above the positive line. And margin debt, this goes back to the end of December. Because a lot of folks just got hammered in 2022, they're not buying a lot of stocks on margin, because if you borrow $10,000 to buy stock and your stock gets cut in half, you still owe that $10,000 back to your broker. So that is a lot of risk, and people are a bit gun shy right now to do that. So that's considered undervalued. And then the mean reversion model, the one that I probably look at the most, we're below this yellow 1 standard deviation line. If we go above that line, we're considered to be overvalued. But now we're not. We're below that line. And then this is the state coincidence index model. The last reading that we got in November, so there's a lag with this, suggests that 15 states have a decreasing state coincidence index. When it gets over 25, then we're looking at a recession that applies to the whole U.S. We're not there yet. We're kind of between the yellow line and the red line. That's 25, and we're still a ways away from that. Looking at sentiment after Friday's session, we're looking positive, so we can go with this. We're not extreme yet. If we continue to go up and we bounce above 75, that's when we'll get into extreme positive territory. Here's a look at the historical price. We had been up at this level before turning back down. That could be a suggestion of sentiment reaching kind of an upper band. But according to this particular model, we only really get excited about this on an extreme greed basis when it goes above 75. Here's the VIX, which has been very low. When the VIX is low, it's time to go. That's the old adage. And this is producing a lot of uncertainty in the market, because the market keeps going up and the VIX keeps dropping. And it's like, wait a minute. When the VIX is high, it's time to buy. Not when the VIX is low, it's time to buy. No, it's when the VIX is low, it's time to go. So there is some confusion there. We had the final reading of consumer sentiment come out. That's the blue line here. It did tick up a little bit. It's still very low overall, but it's at 64.9. We plot the 2-year Treasury yield, which has been coming down slightly, but still, if you look at the bottom, there is a big gap between the two. These generally have a tendency to go in the same direction, and even though they're on different scales, they usually don't get that far apart. They're far apart now, and they're not really going in the same direction. Here's the active asset managers survey. They're getting up to 75. When we get above 80, that's when we're looking a little extreme. Now, this survey is about a week old. With the positive week that we had this past week, this may bump above 80 in the next reading. And then looking at this same survey and then plotting the S&P 500 on top of that, it just shows when we get pretty extreme, 40 and below, that is usually good support for the S&P 500 to go back up. When we get into this red area above 80, that's when we start to see some overhead resistance. We could stay up here for a long time like we've done before. This is just an area where we need to be careful. The right X bear bull ratio shows that folks are still having a tendency to get into the bearish funds. They think the market's going to go down, but it's well off of the extreme reading that we had been receiving just a few days ago. And then we had the weekly survey from individual investors. We really only pay attention to this when we get to an extreme negative reading or extreme positive reading. We're coming up off of this extreme negative reading, and that could be giving some support to the market because they were just totally convinced that the market's going to go down, but it's been going up. So this survey is showing some improvement. When we have really extreme negative readings, if you look at what the S&P did, Now, it can take some time, and we spent a lot of time in 2022 down below this 20 level. You have to say maybe that's helping the market to go higher. The Ulcer Index is also showing that there's some complacency. On the weekly chart, we're quite a bit lower on the daily chart. When we're below the red line, that means there's not a lot of fear in the market. When we're getting above the red line, that means that fear is increasing. Well, we're increasing a little bit, but we're still below the red line. What's the most crowded trade? What is everybody doing right now? Well, in December, most people were in cash or long the US dollar, basically. If you're an American living in America, getting paid in US dollars, you're long the US dollar. Well, that's kind of shifted a little bit in January. These ESG assets, this is quite controversial, whether this gets implemented or not, but a lot of people are starting to stick some money into those types of assets. We have a few people that are starting to get back into China. Oil was seeing a little bit more popularity in December than it is in January. Folks are starting to get back into the bond market, and we're starting to see some improvements there, as well as investment grade bonds. Then these are household aggregates. How many people own stocks or are involved in the stock market, either directly or indirectly? The latest reading has us at about 45%. 17% are in cash, 17% are in debt, which are usually considered to be bonds, whether they're government or corporate bonds. The number of American adults that own stock, it's right at about 58%. So you have households in the previous chart. These are adults. Then here's the bullish sentiment. On this chart, we're getting a score of about 8. It's starting to come back up after giving us a pretty extreme reading. And these are just different events that have happened. The Fed starts their rate hikes. That was pushing the market down. Don't fight the Fed. The market thought that it was going to get a pivot. Powell says no. Then it starts to go back down. The market gets this idea, oh, we're going to have a pivot. We're going to have a pivot. The CPI comes out and kind of dashes all those hopes. The market goes back down. Powell says no pivot. It's been a real game in 2022. We're just wondering what it's going to be like going forward. Here is the Morgan Stanley Global Risk Demand Index. Getting a little toppy over here. It means that folks are getting into a lot of these risk-on type investments. And when we start to get a pretty extreme reading, that could suggest that we're overbought and due for some kind of a correction. As we enter into 2023, that is considered to be a pre-election year. That's the red box right here. And it says midterm years tend to see a big bounce off of the lows, where we get down to a low, average is 11.3%, and then we get back up there and actually then see a 16% return after a year once we've hit those lows. So we have historical precedents on our side and favorable precedents as well. Looking at the economy, the spread between the risky loans and the not so risky loans are still going down. If there were trouble in the economy, we would see this chart really spike up, and that's not what it's doing. And then the Chicago National Financial Conditions Index, when we get above this black line, that means there's trouble. Well, we've been coming back down from that line. So no trouble there. GDP is still being reported in the fourth quarter as being positive, and now they're starting to project out what's the first quarter of 2023 going to be like, and they still have a projection of being positive for both GDP readings. Here's another look at GDP reading from Goldman Sachs. They're also suggesting that we will be positive. We just had the report come in 2.6%. They're still suggesting that we might see positive GDP going forward. Some people don't agree with that. The further out you look, like into the spring, the consensus is that we're going to go negative with GDP and then possibly stay negative into the summer, early fall, and then recuperate back latter part of the year. But Goldman Sachs is still suggesting that we're going to stay positive with GDP. So they're not predicting a recession. That's part of the debate that's going back and forth. And then this is, what's the core CPI? This is inflation. Is it on course for 4%? If we have 0 month-over-month inflation based on the CPI, we'll be able to get back down to this 2%. And that's what the Fed is trying to do. And we should be able to get there by early fall of 2023. If we have 0.1% month-over-month, it's going to take a little longer. We'll get back down to 2.6%. Then if we have 0.3% month-over-month, it'll take us longer, and we'll get down to 4.1%. And then kind of the worst of the scenario here is we have 0.4% month over month. we're going to have a harder time getting back down to the 2%. And that's what the Fed has said their target is. It had been at 2% before when we were under that. And now that we're way, way above that, they're trying to get it back down to 2%. I showed this chart in last week's video. This is suggesting that the middle part of January tends to be weak. Well, now we're coming up into the latter part of January, and it tends to be more favorable for prices to go up. Here's the LEI, the leading economic index or indicator. It continues to signal a recession. We had the reading this past week, and it was not very good. It's coming down below these red black lines here, and when it drops below this level, it's basically forecasting a recession. And then here's the leading economic index and recessions. Looking at the year-over-year GDP, both are going down. The leading economic index is now dropped below the zero line, and that means we're going negative with GDP, according to this chart. So you can kind of see there's a tug-of-war going back and forth. You have GDP coming out from Goldman Sachs saying, no, we're not ever going to go negative. And then we have reports like this that are forecasting that we are going to go negative, and that means we'll go into a recession. Another look at the LEI. This is the rate of change going back 6 months against the S&P earnings per share. They both have been going down, and that's why stocks are really under pressure right now. It's earnings that ultimately drive stock prices. If a company's earning less and less and less, there's less justification for their stock price to be higher. And then retail sales, also starting to see some problems here. They fell the most since December 2021, which was not a good time for retail sales. We've now had negative retail sales over the last two readings. The PPI came out recently, and we have year over year less the CPI year over year. That's the left axis. That's this dark line here, where it has been coming down. So we're seeing less inflation. And then this is the S&P 12-month forward profit margin. That's been coming down, but starting to tick up a little bit. So we can just see the spread between the two. Another thing we look at for the economy is the truck tonnage against the S&P 500. The purple line is the S&P 500, what's going down. And the gold line is the truck tonnage index. It's also been going down. And it says here, trucks represent 72.5% of the U.S. freight and serve as a barometer of the economy. This chart shows the U.S. stock market tends to increase in line with the physical size and expansion. Blah, 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 blah. Even though this is trying to predict what's going to happen, this is not a prediction of what's going to happen. It just kind of suggests that we've gotten really out of kilter here. Are people going to have to start coming in and buying more trucks, or is the S&P going to come down, or is there going to be a combination of the two? People are really experiencing inflation. They're having to spend more money just to get the things that they need for their life, and they don't necessarily have the monthly income to cover that, so they're putting some of these things on credit. We're really seeing a rise in the folks that are using their credit cards and keeping balances on them, as well as the rates that are being charged. They'll walk like a turtle when we're cutting interest rates, and they'll come over and say, yeah, we might lower it a little bit. But man, they'll run at a dead sprint to raise those rates anytime the Fed comes in and raises rates. Here's the economic surprise index. Looking pretty good for Europe. That's the purple line. And this is another thing that I'm going to talk about throughout this video. Europe is looking a little better now. And some folks are deciding, I want to get out of U.S. exposure and get into some emerging markets or European exposure, because this purple line has been going up as the black line has been going down. That's the U.S. So they've been actually surprising with a lot of their economic reports, where the U.S. has not been doing that. And then here's the 12 months ahead recession probability. Another look at the debate going back and forth. This is kind of a scary looking chart. I would focus more on the red line, the 1 year overall. And this is just the prediction. We're about 65% or so chance, based on this chart, of going into a recession. And our economists believe inflation has peaked in the U.S. Okay, here's the other side of this, where the CPI has been coming down, and then the core PCE has also been coming down. And this is the forecast going forward for both. Then this is the U.S. housing affordability. It's likely to improve from a record low. It really came down here. Housing has just been getting hit hard lately. Prices have been going up. Interest rates have been going up. And then that feeds into the housing market. People can't afford the monthly payments, or they can't afford the price of a house. So this has really been dropping. Maybe it's hit some kind of a low point and is starting to bounce back up. Another look at the probability of a recession, calculating the yield curve. We're up at about 60% based on all the different yield curves that are inverted. And then here's the manufacturing surveys. It shows continued weakness. This is the ISM manufacturing PMI. We'll be getting a reading of that in this coming week. And then this is the manufacturing surveys with advanced releases. They're both going down overall, and they're below 50% over on this scale, and we're dropping down below 10 on this other scale. And here's heavy truck sales. They're starting to come down a little bit. If we really start to roll over, and you can see when this really rolls over, we end up going right into a recession after that. So we'll just be keeping an eye on this one. And then the personal savings rate, it's close to a 70-year low. It's gone all the way down here. People are having to dip into their savings just to get by right now, and that's being reflected in some of the data that we're seeing. People are also heavily in cash. They're not necessarily going out and jumping into the stock market. They're just staying in cash currently. And then this is all the money markets. And in May of 2020, this was right in the middle of the whole COVID lockdown mess. People really got into cash. Then it started coming back down. Now it's starting to go back up again. So there's a lot of cash on the sidelines that could come into the market and be put to work if the market looks like it's improving. But until folks are convinced of that, they're probably not going to get in. Here's the S&P Composite PMI and GDP. The thing to take away from this is that GDP, although it's still positive, we're seeing this composite, the PMI, it still continues to drop, even though it bounced up a little in the last reading. This is a chart that tries to take some economic theory and market theory and cram them both together to try to figure out where are we in the economic cycle. There's a gentleman, his name is Dan Byrd. Right at the bottom, you can see this is his email address. He has a free weekly email list that you can subscribe to. He's not trying to sell you anything. It's pretty good. Some of it you might find useful, some maybe not so much. It's also in the description below the video. But he thinks that we're right here, that the market is starting to bottom. We could see the move into a full recession before we start to go back up. And a reminder of the relationship of the market versus the economy, and where are we now? If you wait until the recession, the market will already be much, much higher. This is when we hit the full recession, and then things start to go up in the stock market, and eventually we get to the point where we're out of the recession and we're into a full-blown bull market. You might just want to pause this and look it over if that interests you. Looking at earnings and valuation, this suggests on a historical basis that we're still overvalued. We're at 29.57. The median and the mean is between 16 and 17. The Shiller PE ratio suggests we are still expensive. The S&P 500 companies, they're reporting a lower net profit margin for the sixth straight quarter. It's been going down all the way back into 2021. And then earnings update. As of the time I record this is as of Friday, January 27th, 29% of the companies in the S&P 500 have reported. 69 have been above their estimates, which is above the 67% at the end of last week, but below the 5-year average. Oh, you can go crazy with all the... It's above this, but below that by a certain percentage. And it's below the 10-year average of 73%. So that takeaway that I get from this is companies are projecting lower earnings going forward, and that's feeding into their earnings reports and could ultimately feed through into stock prices. This is saying, according to Morgan Stanley, our earnings model has been very accurate over time, and it's just suggesting that earnings are going to keep going down. And then here's another thing. Looking at the earnings per share against the trend, it actually suggests that we're still way above the trend. So on this, we're still overvalued. And then valuations favor non-U.S. equities, and that's what we're hearing a little bit more buzz about right now. This is just a spaghetti-looking mess. These are different countries with their 12-month forward PE and where they line up down here. You might want to pause this and just look at it. These kind of charts just scare me. Looking at the Fed Watch, we do have the FOMC meeting coming up. There's a 98.4% chance that they're going to raise rates 0.25%, so that after the meeting we'll be at 4.5 to 4 3/4. What I've been hearing is the next meeting after that, it's going to be 4 3/4 to 5%, and then that could likely be the terminal rate. That's been the going scenario for the last 3 to 6 months that I've been hearing. Then the Fed balance sheet, as they said, as of June last year, they're starting to deplete their balance sheet, and it's starting to come down. And this gave a lot of support to the market when it was going up. Because how do they get that money into the market? They buy bonds. Some of that ultimately goes in and buys stocks. When you start taking that out, that produces a lot of headwinds for the stock market. Then looking at the S&P 500, Here's another technical overbought, oversold composite where we're not really getting an extreme reading. When we get above this 75 level or down below 25, that's when we really start to take notice. This is value. We're still kind of going back and forth. Is value the thing to be in, or is growth the thing to be in? The Russell 1000, value relative to the S&P 500, just continues to show that value is outperforming growth. If you're interested in more of analysis of this, please look at my intermarket analysis video where I go into this in a lot more detail. And this is a weekly chart with the moving averages. You may just want to pause this. These are the things that I look at and talk about, not all the time because this is a weekly chart, but I do this based on a daily chart. There's a lot of corporate buybacks, which could give some support to the market. It's not as high as it's been in the past, but it is going up. And then the weekly equity flow just showed that more money starting to come back into the stock market. And then the Eurozone, it's seeing some real interest right now. And so we're seeing a real pickup in those that are in Eurozone equities or stocks. Another chart just shows the insider transaction ratio. And I usually don't show this as much anymore because it's like, does it really help us all that much? But it's really starting to spike up. Now, these are legal insider transactions. That's a CEO, a corporate officer, somebody big inside the company. It just says that they are really buying a lot of stocks now. And when this gets extreme positive, that can be a bearish signal overall. Now, there's also the insider transactions that are illegal. When you take actionable information that's not available to the public and use that to buy low and sell high some kind of a stock. You get in a lot of trouble for that. But this is legal insider transactions, but they have to report this. There's a lag here, just something to be aware of. All right, looking at breadth, we're starting to improve overall based on price and volume. And our advanced decline ratio is above 0, even though it declined a little bit this past week. The blue line's still on top, and it moves faster, followed by the red line. So that's still positive overall. New highs, new lows, seeing a little bit of a concern here. As the S&P has been going up, we're not seeing a real breakout of new highs. Now, if we get up into areas where we haven't been for a while, we might see the new highs advance. But this is just showing that there's not a lot of internal strength right now in the S&P. But we're still going up overall. We're kind of flat to even down on the daily chart. And we're pretty much flat with our 10-week differential on this chart, which is our 10-day chart on the daily charts. Accumulation distribution, when we're above this red line, that means that the big smart money is buying. When we're below it, that means they're selling. We still are positive. Looking at our trend, we're dropping down below 20 now, so we're in a non-trending environment. The green line has come out on top, so we're positive, but we want to see this turn back up and actually go above the moving average. We're above the moving average on the daily chart, but we're well below 20, so we're kind of in a non-trending environment for both the daily and weekly time frames. Here's our rune showing that the number of sellers has been decreasing, but also the number of buyers has been decreasing, so we're still getting a flat reading with our oscillator. The mass index is not giving us a signal. Looking at some long-term charts, first I look at a daily chart, and I have an additional daily chart to show you where we came up over this trend line, and then we were able to stay above that. We got above this daily pivot level, then there's a resistance level, and we came right up to the December highs. Can we break up through that, or is this going to act as resistance and we're going to go back down? That's what we're kind of waiting to see. Also, you notice that the blue line, which is the 50-period moving average, is getting very close to the red line. The 200-day moving average, when the blue line goes above the red line, that will be called a golden cross. And that's going to shift a lot of our market focus from more negative back over to positive. And it could possibly happen this week unless we really fall down below that based on price on the daily chart. Here's the same chart, except instead of looking back 1 year, this looks back 2 years, where it's showing a lot of improvement. And the reason I have this at 2 years, I just want you to see where some of these, they had been support levels we're at before, but now since we dropped down below them and we're coming back up, they've turned into resistance levels. Our trend channel, we're getting up a little bit above the midpoint. And then our pivot points, we're just a little bit above the pivot point on the monthly version of the pivot point chart. When we're above the pivot, that's positive. Below the pivot, that's negative. And our 50-period moving average, we're coming right up to the underside, and actually we're able to get slightly above that. Long-term trend, if we continue and stay above both of these lines. We're going to see a golden cross on the weekly chart. We're getting ready to see one on the daily charts. Bullish percent index going up above 50, advancing and not extreme. So that is positive. Chaikin oscillator long-term also above the midpoint, going up and not extreme. Chaikin money flow still suggesting that we're positive with this. Force index also positive. McClellan oscillator above 0 and advancing and not extreme. That's positive. The summation index based on price and volume both continue to advance. The volume one's getting a little bit toppy here, but we really don't count that until it goes above the red line. All of our oscillators are back to looking positive. Swindle trading oscillator, positive based on price and volume, and both are above 0. The PMO, which takes just one of our oscillators, the price momentum oscillator, it's going up, just like it showed on the other chart. We're advancing based on price and volume. Then we have PMO studies that look at the PMO and then look inside the PMO to see when it's measuring the S&P 500. Those stocks that are rising, the percent, continue to advance. The buy signals also turning back up, and those that are above 0 also advancing and getting close to an extreme territory reading. The RSI based on 14 weeks is above 50 and advancing, so that's positive. The special K is still above this red moving average, but it is declining. If we can turn back up with our prices, this should turn the special K back up. Stochk RSI is extreme positive. Williams percent are looking extreme positive. Now, it doesn't mean we have to stop right here. It just means that we are getting a little overdone as far as how price has been moving. You can see looking back where it can stay in these extreme positive areas for a long time. Vortex indicator is positive with the green line on top and the red line on bottom. The ultimate oscillator is above 50 and advancing. Money flow still under 50 but advancing. Bollinger Band not giving us an extreme reading. When we move really fast, either up or down, that's when we start to really take notice using this indicator. And it's positive because it's going up, but it's not giving us an extreme reading. The rate of change going back 1 week is positive. Going back 50 weeks is also turning back up. The Copic curve gave us a signal back in November. We also were given a daily signal in early January, and both of these are going up. The KST, which is another momentum oscillator, is positive. And then the weekly chart shows that we're above this 38.2% retracement. We're above both moving averages, and we had a good solid bar here. Can we break above those December highs? Looking at our different charts, the Heiken Ashi turning back to positive. The Kegi black line advancing, that's positive. Renko open box is positive. Ease of movement going back 1 week is positive, and we're above the 0 line. It's pretty much flat going back 14 weeks because we've been chopping around a lot. No signal with the point and figure chart, but we did have a new X drawn in this past week. 3-line break looking more positive. The Elder Impulse system for the S&P has a green bar, and we're getting above this 65-period exponential moving average. The Parabolic SAR system has the dots below, so that is positive. And looking at our different indexes, here's the S&P, the mid caps, and the small caps. We're seeing a little bit of lagging between the mid caps and the small caps from day to day. In a healthier environment, we would want to see the small caps and the mid caps perform better than they have been. Then all stocks, this takes U.S. stocks and international stocks. We're just getting ready to see a golden cross here. We've seen a golden cross now on the daily chart. This could happen pretty soon. Mid caps also showing us a recent golden cross, turning back positive. The small caps not quite ready to cross yet. The Dow gave us a recent golden cross. The NASDAQ still has a ways to go, even though it's been performing well lately. It's got a lot of making up to do. Same thing with the NASDAQ 100. The Wilshire, broad measure, still a ways to go before a golden cross, if that even happens. The NYSE is giving us a golden cross. The FANG stocks doing well as of late, but still have a lot of damage to repair. Same thing with ARK. It's got a long way to go back. The 30 biggest software companies also had a good week last week, but still in an overall downtrend. This is Dow theory. We're looking for some kind of convergences or divergences. Not really seeing anything all that drastic currently. Then looking at the broad market, the CRB index has been in a recent death cross and is in an overall downtrend. That measures more inflation. Copper has been holding up fairly well. It's still in an uptrend on the weekly chart, and it's spiked up and it's just kind of sitting where it's at. Gold is giving us a potential golden cross now. Silver already gave us a golden cross, so it's getting more in an uptrend. Oil dropped down almost down to 70. It's been coming back up. We dropped down below 80 this past week. We're at 79.68. This is some forecasts from Goldman Sachs suggesting that we're going to get back up to 90, 95, and eventually at 105, where the futures market is not that ambitious with their predictions. They think that the oil prices are actually going to go down. Here's a weekly chart of the dollar. We're still in an overall downtrend after really moving up in 2021 and in 2022. And this is a weak dollar bodes well for non-U.S. equities. And that's what's helping a lot of the foreign stocks to have some support right now is the dollar weakness. And this is the U.S. trade, down here the dark line, and then red are stocks. And they're starting to turn back up. Looking at bonds and interest rates, bonds are showing some improvement on the daily charts. Not quite ready to have a golden cross on the weekly chart. And then investment grade credit funds saw inflows over the past 4 weeks. People are starting to put their money back into the bond market. And then never seen 3 straight years of treasury losses. We had a bad 2022, one of the worst ever for bonds. And even 2021 was not very good for bonds. Are we going to end up seeing a good year for 2023? Here is the daily chart of yields showing how we've been coming down overall, even though we had some upward movement later in the week. And then here's the MOVE index, which is the VIX for the bond market. It shows volatility has been decreasing a little bit going forward as bonds have been going up in price. And then this is a weekly chart looking at the US, the UK, and Germany. That's the green, black, and blue area here. And then Japan is down here. They kind of have their own scenario going now. Feeding into that scenario is that the Bank of Japan bought 76 trillion in Japanese government bonds over the past 7 months. That's 14% of Japan's GDP. Buy, pushing bond prices up, keeping interest rates down. That's what they're trying to do. If they lose in this battle, that could feed in to the Japanese bond market. Japan also owns a massive amount of U.S. government bonds. If they have to start selling those bonds to make things good again, that could push interest rates up in the U.S. So we're just keeping an eye on that. And then major central bank policy right now, you might just want to pause this. The main one that we're focused on is the Fed funds rate. And that's the blue line up here. It just shows how the other central banks have been raising their rates also. Looking at some relative studies, here's our intermarket analysis going back to the beginning of 2022. Oil is still in the lead, followed by the dollar and gold. And then we still have stocks and bonds negative. Then bonds against the S&P 500 still continue to underperform overall with your shorter term maturities. The stocks have been outperforming bonds. We're seeing a little bit of weakness, but this is starting to turn back up because stocks are seeing some healthy moves. Gold to the US dollar is just showing how it's starting to recover. We could be getting ready to hit some resistance soon. Then gold to the S&P 500, even though it declined this past week, is still in an overall uptrend. Low volatility stocks really getting hit now. They were the place to be in for all of 2022, even though there were some real gyrations here on a relative basis. We saw some recent weakness. And growth against value, growth is still in an overall downtrend, even though it had a good week this past week. The NASDAQ 100 against the S&P 500, still in a downtrend, but showing some improvement. S&P 100 is improving against the S&P 500, but still in a downtrend. Discretionary versus staples. Discretionary is still underperforming, but really starting to roar back. Can it continue? Energy against the tech sector shows that energy has been really outperforming tech. Here's an interesting one put out by Martin Pring. This is the S&P 500 divided by the Dow Jones World Index, and this is a ratio. And this goes all the way back to 2011, where we've been in a pretty solid uptrend. We're starting to come down right now, so we could be at a real inflection point. If we turn down, that could be negative for the S&P. If we can bounce back up off of that, that could give some support to stocks. Down below, you have his version of an oscillator, the KST, no sure thing. That's what it's supposed to mean. we are rolling over right now and could be turning down more negative. Now, these are long-term charts. This is a monthly chart going all the way back to 1992. Since 2011 anyway, some people take it all the way back to 2009, that we've been in a secular bull market ever since that time. Here's another look at the S&P 500 against the Europe, Australia, Far East ETFs. Again, getting some international exposure. We're also starting to come back down to this line, which has been a long-term trend. The pink areas, this is a PPO, another oscillator that we like to follow. When it's above zero, that's positive. When it's dropping below zero, that's negative. And you can see it was below zero, and so we were massively heading down. And then here's 2009 into 2010 where we were going lower. And then here is 2017 into early 2018, and we're starting to go negative. So again, just a warning sign. Is the market going to be able to bounce back up off of this, or is it going to fall down below it? And I have these charts, and I'll be updating these as needed. This is the S&P against another international ETF. I don't know if I really buy this all that much. He's saying this is a shoulder, here's the head, here's the shoulder. It has to be a little more symmetrical to my liking. Why isn't it this shoulder right here? Why is this line here? I don't understand how some people draw their lines. It goes against the textbook definition, but that's just my opinion. I just wanted to include this. The thing that's interesting on this chart is the rate of change going back to 2008. We're starting to hit a low and turning back up. So that could suggest on a ratio basis that the S&P is starting to improve. Then here, new leadership is in non-US stocks. They've been going down. Now it's starting to turn back up. All right, our outlook then for this coming week. On Monday, we don't have any economic reports coming out. On Tuesday, the Chicago PMI, Employment Cost Index, Housing Price Index, and the Case-Shiller Home Price Index, as well as Consumer Confidence. Then on Wednesday, we have the Mortgage Applications Index that comes out every week, ADP Employment Change, as well as the IHS Market Manufacturing, Construction Spending, and then the big one on Wednesday will be the ISM Manufacturing Index, as well as the JOLTS job openings. Then on Thursday, we will have jobless claims. That's a weekly report that we get. Productivity and unit labor costs. It'll be the preliminary reading, followed by factory orders. Then on Friday, it's the big one, employment situation. If it's hot, that could put some real pressure on the markets. If it comes in weaker than expected, because that's what the Fed's been waiting for, is a weaker employment situation. If we start to see signs of the employment situation slowing down, that could give some short to intermediate term support to the market. And even longer term, if it brings in the idea that the Fed may be getting ready to pivot. The IHS Market Services PMI will be coming out, as well as the ISM Non-Manufacturing Index. That's another biggie. Our technicals, as you can see, they're turning more positive overall, both on the daily charts and on the weekly charts, because we have this inflation and interest rate concern that's really ridiculing the markets right now. And then we have to be aware of the Russia-Ukraine situation, as I talked about. We'll be getting a lot of Fed speak this coming week because of the FOMC meeting. Then I'm going to be updating this again for next week's video. So right now, this is just what things look like for January 30th. The Dow's kind of not all that great. It's up 47.6% of the time. The S&P's up a little more than half the time. The Nasdaq's down a little more than half the time. So we're kind of neutral overall with that one. And then the last 23 Januaries, we've been down more than we've been up. We're still in that window for November, December, and January, the best 3-month span. And this is the one that we're waiting for. We're waiting to see how January closes. Now, it's probably going to be positive unless we have just a massive crash. The January barometer states that the year that follows January follows at 83.33% of the time. So if we have an up January, 83.33% of the time, the market's up for the year. And vice versa is also true when you study things going back to 1950. Right now, we have a 2-0 score. If we have a positive January, that will bump it up to a 3-0 score. And I'll have some more of the statistics and everything to show you next time. And the markets also like that we have a divided government now between Republican and Democrat. Here's another chart just saying that we're waiting to see what's going to happen with the January barometer. You can see these are what the returns are like when the market is positive. I showed this in last week's video. This last chart is also from the Stock Traders Almanac, and it's what do we look like if we get a 3-0 positive score, especially after we've had a bear market the previous year. Well, here's the black line is the Dow, and it's up over 20%, as is the S&P 500. And the NASDAQ is up over about 30% going forward. These are just statistics. Just because we have this, if we end up getting this reading, doesn't mean this is what's going to happen. It just means this is how things tend to behave after we've had a positive January. So our scenarios, and this is based on the daily charts, can't really go with the down scenario, even though we're getting short and intermediate term overbought. It's hard to go with the up scenario because we're just not trending now, even though we're seeing a lot of improvement. The scenarios that we look at, our sector rotation, our setups, not really working off the setups. Those work best when we have an extreme negative reading and then bounce up out of that. But our scenarios and rotation are showing some improvement. Our technicals are improving on the daily charts, and we're breaking through some overhead resistance, but we're still going with the sideways overall trend because we're below 20. We're now below 20 on the weekly chart, so we're more neutral as the market tries to figure itself out. Thank you. I hope you found this helpful. Please feel free to check out the daily videos that I post, as well as the intermarket analysis video. And then I'll also be posting the deep dive video where I go through all the daily charts that I don't bring up in every video, just to give a look at how things are going. Have a great week, and I'll talk to you in the next video.